There are 10 mistakes that people make when it comes to investing, especially when starting out. And by making those mistakes, people end up losing money. So let's take a look at those mistakes so you can avoid them and get maximum results. Number 1 is waiting too long to start. And that may be because you think you have time, maybe you have other priorities in your life right now like travel or shopping, or you think you can always save and invest later when you earn more. The thing with investing is that time works in your favor, and that is because time is a factor in compounding, in compound interest. So the longer your money can work for you, the more it gets. So the best time to start investing is always at your birth. Others say 10 years ago. The second best time is now. And with time working in your favor, you don't need huge amounts of money to get the same results as other people who started later. Let's say, for example, you save $1,000 per month and you start investing at the age of 25. After 40 years of saving, so at the age of 65, with a $0 initial investment and an interest rate of 6% per year, you will end up with $1,857,143. Now let's look at another person who starts 10 years later, so at the age of 35, also invests $1,000 per month, also until the age of 60, so that is 30 years of saving with a $0 initial investment and a 6% interest rate per year, and this person ends up with $948,698. So that's half of what you end with just because you started earlier. So the take-home message for mistake number 1 is invest as soon as possible. Now let me share some numbers to get to the second mistake. Americans believe that they need $1.27 million to retire comfortably, but they currently have saved and invested less than $100,000. And even though these numbers are over all age groups, this is still a huge discrepancy. So mistake number 2 is not invest enough. When you start investing, you might start out with little amounts to test it out. And that is totally fine to see if you react and how you react and handle the market fluctuations. But as soon as this testing phase is over, and it should not take more than a few months, definitely not several years, you need to increase that number. I think what might actually happen more often is that, for example, you set a savings rate and also an investment rate, and you set that rate based on your first income or the income you have when you start investing. And now you're making more, but instead of investing more, you increased your lifestyle, which is totally fine. We want to live our life and enjoy the fruits of our labor. But the thing is, the more luxurious your lifestyle gets, the more money you need to keep it up. And therefore the more you need to invest, because no one will take care of that for you. And the overall amount we invest becomes our principal, and the principal is also a factor in the compound interest equation. And the bigger the principal, the more and faster it grows, and the more you can take out later. And the principal at the same time is also the factor that we have the most control over. So invest as much as possible at any given time point. And the way I do it is, when I earn more, I take the difference and I invest 70% of the difference, and 30% I use to increase my lifestyle. Of course, a 50-50 split is also possible. Mistake number 3 is that you don't invest aggressive enough. When you start out investing, you might begin safe, and that's okay. Maybe you follow some common standard investment strategy like X% bonds and X% stocks. In the beginning, almost everything counts as long as it gets you started to invest. But then when you've been in the game for a couple of months, it's important to adapt the strategy. And the reason is that the interest rate of our return matters. Because the interest rate is the third factor in the compound interest equation, and playing it too safe at a young age costs you money in the long run. When you are in your 20s, you do nothing wrong with holding 100% in stocks, besides your emergency fund, because you just have plenty of time to, sit out the fluctuations of the market. I'm in my 30s and I still don't own any bonds. And especially when you notice that either you don't even look in your portfolio, or you look into it and the red numbers really don't bother you that much, don't hesitate to change your portfolio to more risk, because then you also have a potential higher return. You can do that by increasing the stocks part, or by investing into small caps and emerging markets. And even here you can start small and then grow it a little bit more over time. And of course you can also look into other investments like P2P lending or crypto. Just check in once a year if your investment strategy still fits your needs and also your risk tolerance. And if you like what you've watched so far, I invite you to subscribe to this channel if you want to learn more about building wealth and also financial independence. Now, mistake number 4 is get sold. And by that I mean you invest in products an advisor is selling you without doing your own research. Especially when it's products that are combined with other products. For example, you buy an insurance and that is like combined with investment. And most of the time they have many hidden costs and they don't really pay off. Also because the advisor is benefiting from you buying the product. And as a matter of fact, one of my first investments was a product like this, and it took me some time to really get to the bottom of the costs of this whole thing. Then once I realized, I stopped the payments, and later on I sold it, I took the loss and instead invested it with something with a higher return. And a similar situation is with mutual funds. And I don't mean the index mutual funds, but the classical mutual funds that have a fund manager. And the thing is that over 80% of those mutual funds don't outperform the market, which means getting higher returns over a longer period of time as the market itself. But at the same time, they have a 1 to 2% management fee and also other additional fees, and this can cost you tens if not hundreds of thousands of dollars in cost over your lifetime. And I think the worst thing about this getting sold is that you actually feel good about yourself because you've done something about your situation, you started to invest, and you think it's taken care of unless you actively take a closer look again. The only situation where I would not consider this a mistake is if otherwise a person wouldn't invest at all, then it's still a win. But here you landed on my channel, so I think you can do better. In case you are already an advanced investor, you might fall trap to mistake number 5, which is try to time the market. One of my favorite investing wisdoms is time in the market is better than timing the market. And I know the deal. We want to buy the dip and then we want to sell at a high. But the problem is that we never really know if we are in a dip or when the next one is coming. And this then leads to paralysis and we end up not buying at all. And then we lose out on potential gains. Now, unless you are a professional investor and it is your full-time job, there really is no perfect time to invest in the market, except for when you have the money. There is another exception, I will get to this in a second. When you're anything like me and you don't have like 500k on the spot to invest right now, chances are you also do have an income and you invest your money over time. That means you will automatically do what's called dollar cost averaging, and that means you invest the same amount of money every month, and that way you end up buying more shares when the market is down because then they are cheaper, and you buy less shares when the market is up because then they are like more expensive. But overall your portfolio will grow over time. Now there is a discussion if you should rather do this dollar cost averaging or invest a lump sum all at once if you have. I think the discussion doesn't even matter to us unless you have a lump sum to invest. If you have a lump sum, like for example you get a bonus from your work or you sell something, then mathematically it's actually better to invest the lump sum, so everything at once. Because then, well, time in the market is better than timing the market. And to split this lump sum up over several months of investment doesn't lead to a better performance. However, it is psychologically easier. And because you buy at a higher price and then at a lower price, it's also a less volatility because you don't see your whole lump sum go down if the market goes down after you bought. But at the same time, this doesn't mean less risk because you still end up putting everything in the market. And now we come back to the exception. The only time when dollar cost averaging was actually performing better than lump sum investment was when the market goes down, because then you really buy the dip. So if you imagine a down curve, you maybe start buying here and then you buy here and then you buy here and then you buy here. And then after it goes up again, you will have a very good performance. Now again, the problem is we never really know when the next dip is coming. I would say the last obvious one was during COVID. That was also the time when many people started to invest because they had some time on their hands, and then it also was a good time. So when it's that obvious, it's actually nice to have some cash on the side to invest it. But in my opinion, ideally we invest what we have so we can put our money to work as soon as possible. So with a stable income, this doesn't matter. You should invest as soon as you have the money. If you have a lump sum, I would still recommend to invest it all at once. But if it's easier psychologically to split it up, I would also do that. Maybe then over 3 or 4 months, which is still better than not investing it at all. And I actually can speak from experience here because I had that situation where I had a bigger chunk of money that I wanted to invest, but I noticed over a few days that I just had a hard time putting everything in at once. And so so I realized, okay, it's easier for me to just split it up, so I split it up. I don't think it's going to be that much of a difference after 20 or 30 years. Mistake number 6 is investing without a plan. And that can either mean that you buy funds or stocks here and there without having a real system. So you have the money, and when you feel like it, you buy something, but there's really no strategy behind it and no asset allocation. It can also mean to follow the herd without doing your own research. That's especially unfortunate if it's high-risk investments that you heard about in the news. And then one possible consequence is that you have to take the loss and lose money. Or worse, you get so scared that you never invest again. And both of those ways can cost you a lot of money. And it can also mean to fail to diversify enough, for example, when you only have a handful of stocks. Now, to avoid this mistake, you can take a few weeks to look into the different kinds of investment and do your research. And then you can start investing with a clear map. And from there you will change direction over time, because the longer you're in the game, the more you know, and also the more comfortable you get, and that is normal and that is good. And also then you're having a good starting point. Mistake number 7 is to invest money you need short term. And that means you are not prepared for emergencies, and then you have to sell your investments in order to cover the emergencies. And one of the reasons for that might be that you don't have an emergency fund, or that it is not high enough. And the market is volatile, and you should not and cannot expect anything good in less than 10 years. So build up your emergency fund first, and if you plan purchases, for example a down payment for the house within the next 3 years, this money should not go into the stock market. Investment mistake number 8 is to interrupt compounding. One of Charlie Munger's investment rules is never interrupt compounding unnecessarily. And you interrupt compounding by taking the money out. That can be because you're not prepared, like we just talked about. It can also be that your investment strategy is not risk optimized, and then you panic sell. So we want to let the money we invested stay invested so that it can work for us and compound and grow over time. Investment mistake number 9 is underestimating costs. Now, costs are one of 2 essential factors in every private investor's performance. The other one is asset allocation. And not paying attention to fees and expenses can cost you tens, if not hundreds of thousands of dollars throughout your lifetime. And costs also diminish the returns. And these costs can be costs related to accounts, like for example account maintenance fees. It can be costs related to investments. In funds, this can be management fees. In fixed income, this can be penalties like early withdrawal. When it comes to real estate, those costs are interest rates from the banks, also renovation costs, and also costs when the tenants don't pay their rent. And costs can also be related to regulations. For example, taxes are also a kind of costs that you should pay attention to and keep as low as possible. And mistake number 10 is not investing at all. And I don't think that's you, because you're watching this video. But I think there are people who either spend all their money, so don't save and invest at all. But there are also people who actually live below their means and save money, but they don't invest it. And then they still lose out, because money loses its purchasing power over time because of inflation. And to be poor at an old age is a real fear in our generation, and unfortunately it's also not that unrealistic either. At least for people who don't invest at all for themselves, because the state will not be able to cover all of the costs in our aging societies. So if you want to take the next steps to investing, I'll link a little playlist for you here. I hope you got some value out of this. Thank you for watching this far. Thank you for spending your precious time with me, and I hopefully see you in the next video. Bye bye.